Hello and welcome to this week's episode of Spy Trader Now. This week is 3/4/23 and our portfolio is up 1.91% year to date. And we use the benchmark of the S&P 500 buy and hold investor where their portfolio was up 5.69%. Our goal here at Spy Trader Now is to beat the returns of the buy and hold investor for the S&P 500. And we use the ETF symbol SPY in order to do that. And when we do our trading, we do it with a 3-position portfolio. So it's a very simple portfolio. We have either shares of the ETF SPY directly, or we buy or sell options, SPY options, or we are in cash. Now, we did have a trade during the week, and I'll show you that. And it was a cash secured put trade. That trade expired on Friday, so we are currently in cash. And that's where our portfolio currently resides. So that's why I've got it depicted here, 100% in cash. Here at Spy Trader Now, we buy, sell, and trade the S&P 500. And we try to put more of this green in your wallet. Now, here is a 1-year chart for the S&P 500. We are going to go through the charts in much greater detail later on in the presentation. Here's the trade that I made during the week where it was on 3/1. I made a trade for a cash secured put with 3/3, which was Friday as the expiration date, 390 strike, and I got a 90-cent premium. Now, when I made that trade, let me show you here in the thumbnail, that was on this day here, where it was what's called the doji candle, where the tail and the wick are about equal to the equal lengths with a small body in the center. The next trading day, this candlestick is called an outside trading day, where the low and the high completely enveloped, the body of this candle completely enveloped the previous trading day, and it closed up high here, which was what's known as like a bullish washout key reversal day. So it washed out the lows, went into the highs, and then the next trading day just went off from there. So all the action of last week happened in the last 2 trading days. I made my trade 3 days before, so I didn't see these 2 last days prior to me making that trade. Our trade was still profitable, but just by a small amount. And I wanted to take a conservative trade because I wasn't sure if the market was going to continue to fall down. It was very difficult to forecast exactly when this bottom was going to reach. Although I did have 390 as a support level. So I knew we were getting close, and my fear was that we were going to break that 390 level. So that's why I just did a very short-term trade. Here is past results of Spy Trader Now. In 2022, we returned 21% compared to the S&P 500 that had a negative 19.48%. That's a 40% differential, folks. Fantastic return on investment last year in 2022. 2021, we did 78% compared to the buy and hold investor, 28%. And in 2020, a fantastic year, 100% return, whereas the buy and hold investor only returned 15%. If you have not done so already, go ahead and hit that subscribe button, ring that bell to be notified when I post a new video, and do me a solid and smash that like button down to help me promote this video. Thank you. This here chart is just to show you what last week did. So the S&P 500, the SPY ETF, they gained 1.97% for the week. Here is that trade that I made last week. The trade notification went out on Wednesday, March 1st at 7:03 a.m. Pacific time. And the trade was using 78% of the portfolio. Even though I did a cash secured put, I set that money aside and I leave it in cash, although it wasn't deployed, just in case the market was to fall below our strike price. We had the cash ready to go, no margin needed, just in case. That wasn't needed because the market just took off. So but this was the trade that I made. And I put the information in the cash secured put calculator to determine what the return on investment is, and annualized that returned out to 42%. Now this was just a 2-day trade. If you want this calculator, you can get this for free by heading over to spytradernow.com, and I'll leave a link down below so that you can do so. Here is that trade that we made last week on 3/1/23. 390 was the option strike price. The expiration was 3/3/23, cash secured put trade, 78% of the portfolio. We got a 90-cent premium for that trade. That trade expired out of the money, so we were not exercised, so we just pocketed that $178 and put it into our portfolio. Every year, we start our portfolio off at $100,000, so we have some capital, and currently we are at $101,909.60, up 1.91% year to date. Here is our equity curve for the year of SpyTrader Now, so you can see that. This is a year-to-date equity curve. Here is the equity curve for the S&P buy and hold investor, where they had a very good, fantastic start, came back, pulled in, and then jumped up. And all of this happened over the last 2 trading days. Here is the 2 portfolios combined on a percentage basis so that we can compare ourselves to see how well we are doing. So here we are. Here's the S&P 500 buy and hold investor. Obviously, we have a lot of work to do in order to beat this portfolio. That is our goal here at SpyTrader Now. We try to beat the returns of the buy and hold investor with a very simple portfolio, making no more than 1 trade per week, and in order to do that. Here is what the Fed is doing. The Fed's last interest rate hike happened on February 1st, 2023, 25 basis points, brought the funds rate to 4.5 to 4.75. If Forbes has it pegged in 2023 to bring the terminal rate to 5 to 5.5. There was some inflationary data that came out during the week that now they're thinking that this terminal rate may go to 5.5 to 5.75. We will know more as the meetings move on. So the next meeting is going to be on March 22nd is when they'll make when the Fed Chair Jerome Powell will make the announcement. And we have 25 basis points baked in the cake, and that is pushing to possibly 50 basis point rate hike, or they're just going to extend out the number of 25 basis point rate hikes out a little bit further. So that is what the market is digesting right now. We will know more as we get closer to March 22nd, especially after that announcement. We'll know a lot more. Now here is the look for the stock market according to the bond market. And we need to pay attention to what the bond market has to say for a couple of reasons. First of all, the bond market is huge compared to the stock market, like 4 times larger than the stock market. And the bond market, generally speaking, is smart money, where smart investors are looking at the bond market. And the bond market is telling us that the stock market is extremely risky right now. So it's very bearish. And the reason why the bond market is saying that, and the way that they say that, is by the yield curve. Currently, the 10-year yield is at 3.92%. The shorter term 3-month and 2-year yields are at 4.75 and 4.81%. This 10-year yield is supposed to be higher than the shorter term 3-month and 2-year yields, and it's not, it's lower. So the bond market is showing that that's a poor outlook for the future. In addition to that, when you have an inverted yield curve, that is a precursor to an economic recession here in the United States. So bad times for the economy ahead is what the bond market is saying. In addition to that, we have rising interest rates. 1 year ago, the 10-year yield was at 1.72. Today, the 10-year is at 3.92. That's a rising interest rate. All of these things, according to the bond market, is telling you to be out of stocks. This information was derived from bankrate.com. I'll leave a link down below, and it was updated on bankrate.com's website on 3/1/23. So it's only 2 days old, this data. So it's very fresh. Here is the seasonality outlook of where we stand. We are now in the month of March 2023. When I look at it from a seasonality of SPY and I go back 20 years, there's a 70% probability that we will close this month higher than when we opened it. And that is very good odds that the market is going to close higher than when it opened the month. Right now, these are monthly candlesticks. We're in the month of March. There's a 70% probability we're going to close higher. Currently, we are 2% higher. So we've already met that. So the probability of us going lower than 2% is only 30%, and the inverse of the 70% probability that we're going to close higher. So we have very good odds in our favor to go long during this month. And right now, with only being up 2%, this is good. Here we're looking at a chart of the S&P 500, 20 years, and we were in this downward trading range. We just broke above it. As long as we stay above this line, which was resistance but now is acting as support, as long as we stay above that, we are in a bullish position for this market to drift that way and go north. The MACD is at a low stance, not below zero like it was back here in 2009, but still a low stance where it can now bottom and come back up, and it has plenty of room to grow. The slow stochastics has, if you'll notice it here, it bottomed, came up, pulled into the signal line, bounced off of it, and now is trading up. That is good. That is good to go long on the S&P 500. This is an intermediate standpoint look, and we're looking at weekly chart, 5 years. Each one of these candlesticks is 1 week's worth of data. And we are in this trading range. You can see that support line here a little bit closer, and as long as we stay above this support line, we are good. And we need to break out first above the 410 and then above this level here, about 415, for this market to really take off. Here you can see the MACD has come in, was traveling towards the signal line, but now it's changed its trajectory, and it is now beginning to run parallel, and hopefully will go in the opposite direction. It has plenty of room to grow because we're close to the zero line, plenty of room to get up here. The slow stochastics is negative below its signal line, but it has changed its course, and it looks like it's going to bottom and hopefully bounce. Here is a daily chart, so it's going to be a short-term outlook, 1 year S&P 500, and we were in this downward wedge pattern and we broke out. That's a bullish condition. This was a bullish flag formation that was happening. We got close to that 390 level, and we basically just went up and bounced off of it. So this is another good indication that we need to be long this market. The MACD has bottomed, hasn't crossed above its signal line, but you can see it's clearly bottomed. Histogram, everything is traveling north. Slow stochastics already above 20 and above its signal line. Now here it is, daily chart, but instead of going back 1 year, we're only going back 6 months. Here you can see those last 2 trading days really clearly. I got a bunch of lines drawn in here because I did the wicks of the candles from here to here, and I did where, because this was one outlier, I took that 1 day out and I did this red line here to see where that was going to land. We actually came below both of these support lines that I had drawn in, so we had broken down below that, both of them, but we did not even touch the 390 level before bouncing. Now we're looking at the VIX, or the volatility index, or the fear index, and we are way down in the VIX. We are at 18.49, and what I've done here is I've drawn in a support line at the tails of all of these candlesticks of when the VIX is at this level, and we are at that level right now, as of the last trading day. So you'll see here in these blue dotted lines over the last 4 times that we did that. In this black line here, that is the S&P 500. So as an example, the last time that the VIX was at this low level, the S&P 500, this black line was at this level here. The next 2 or 3 or 4 trading days came down. And then over here at this one, when it was at that level, came down about 1 or 2 trading days. Let's see here, just to see if I can get, yeah, 2 trading days. And then over here on this one here, it came down, but you'll notice that it acted jagged, and it was a rough ride all the way down to where we currently just bounced. So it's difficult to trade off of the VIX, and this is the reason why, but it gives you a good indication of what's going to happen. So here we are right now. So there's a good probability that we're going to pull down a little bit because the VIX is theoretically going to bounce up. When that bounces up, this number on SPY is going to come down somewhat, 1 or 2%, and then should hopefully take off from there. As long as the VIX stays below, right now the way I'm pegging the VIX is it's in this trading range. This is support and this is resistance. And as long as the VIX stays within these boundaries, we are good to go along the S&P 500. Now we did cross on the MACD, it crossed below its signal line, which is bullish for equities. The slow stochastics is heading south, but it is almost at an oversold condition where it's going to bounce. So I am expecting a bounce in the VIX, which means the SPY is going to pull back over the next 1 to 2 trading days. Now we are looking at a 1-year chart, S&P 500, but on the TD Ameritrade Thinkorswim platform. These gold lines are standard deviation, -2 and +2. The pink lines are minus deviation, -1 and +2. Excuse me, +1. 95% of all trading takes place between the -2 and +2, and about 65 to 67% between the +1 and the -1. We are currently butting our heads up against the +1 standard deviation line. Now it's very easy, it's going to come up above that and go to about 50%. So we have about 50% between the +1 and the +2, about 50%. And so we have a little bit room of upside to go, but we have plenty of downside to take this down to previous levels. In addition to that, you'll notice that the lines are sloping down. So over the last 1 year, the stock market has been in a pretty much a downtrend. Now, looking at the next slide, this is the same thing, except instead of going back 1 year, we're going back 3 months. You'll notice how the slope has changed. Now, the standard deviation slope is traveling north, which is good, bullish for equities. We came down to below the -1 standard deviation, about halfway between the -1 and -2 before we reached that bounce. So this was a perfect level to go long. And we were in that trade. At that time, we had that cash secured put trade that expired here on this candle. I'm expecting a little bit of a pullback and then go long again. Now, hopefully, my expectation is that the SPY is going to travel up, reach this +1 standard deviation line, or a little bit above that, at the maximum +1.5 before doing this and heading back down. So, as of March 4th, 2023, market summation according to SPY Trader Now, the market is expected to pull back over the next 2 trading days because of the VIX is really helping me see that. Then move up to a maximum upside of 3 to 5.8%, with 3% being more of the realistic number. So if we pull back 1% and we go up 3% from here, that's a 4% rise. We want to get in on that 4% rise. That's what I'm looking to try to do. And the market's going to do what it wants to do, but this is my expectation. Once we get up to that 3 to a maximum 5.8, which is the +2 standard deviation, we're going to change trend and start heading back down. So what I want to do is I want to wait and watch the market, and when we get a 1% or greater pullback, we'll go long. Now, we have choices when we go long. We can buy the shares of the S&P 500, which is what I expect to do, or if I felt more bullish and I wanted to take on leverage, we could do options. But especially with the bond market being with an inverted yield curve, I really don't want to take on that much risk. But I do want to participate in market action, and this is how I expect to do it during the week. I hope you got some good information out of this video. You can head over to SpyTrader now if you want to learn more about me and my stock trade service, and if you would like to sign up for real-time trade alerts. If you have not done so already, go ahead and hit that subscribe button, ring that bell to be notified, smash that like button down to help me promote this video, and I wish you good trading.